Hi, this is Mike Maloney, and I quickly wanted to revisit the yield curve. This is stock charts, and this is a wonderful little gizmo they've got called the dynamic yield curve. And you've heard in the news most likely about the yield curve flattening and so on. Now, the yield curve is the interest rates that the different treasury instruments pay. This is the 30-year bond, the 20-year bond. This is the 10-year note, the 7-year note, the 5-year note, the 2-year note, and this is a 3-month bill. Anything shorter than 2 years are called bills. 2 years to 10 years are notes, and over 10 years are called bonds. I don't know why, but that's the way it is. So what's interesting about this, though, is, we've been hearing people talking about the flattening of the yield curve, and this isn't flat. It's still sort of a positive curve. When it is low on this end and then curves over, that's called a positive curve. And you can get an inverted curve also. The neat thing about this dynamic yield curve is it has the SP500 Index plotted right alongside it, and you can sweep through with this bar here and see what the yield curve was at any given moment in time according to the bond auctions. And this is still a positive yield curve, but as we get toward the crash of the NASDAQ, you'll see that this curve starts to flatten and short-term interest rates go up. This means that investors are nervous, and here you'll have a completely inverted yield curve. Now, this means that investors are nervous and they charge more for the government to borrow their currency for 3 months than they do to loan it to them for 30 years. They're thinking that, well, maybe over a 30-year period things are going to sort of work out, but in the short term something's going to happen and I'm worried. And these investors tend to be right. So this is the S&P 500 Index, and these bond investors, the bond vigilantes they're called, predicted this crash. And then you'll see something interesting happen. This 30-year bond starts to stick. Now, that isn't because the interest rate was fixed. That's because Alan Greenspan eliminated that bond for quite a while. But this is a positive curve. And then what you'll see is that we start to go into the real estate bubble, and it starts to flatten here. And here, investors, a whole year and a half before the peak, are predicting that there is something wrong with something sick in the market. And bond investors know that there's something up, and it goes inverted here a whole year before the peak. And then it starts to crash, and you'll see that Ben Bernanke takes this short bond, or short, these are notes, down to 0.25%, so 0.25%, and he pegs it there, and it just stays. And then later you'll see that Janet Yellen brings that up to 0.5%, but this is a healthy shaped curve. Now, this end of it, though, is totally manipulated. This is completely manipulated 100%. The Federal Reserve ends up buying any bonds that don't get auctioned, and they buy them at this pegged rate. And so they've got unlimited deep pockets. They buy whatever is for sale, and they set that price. But that affects the prices of these maturities that are near that short end of the curve. And then as we go along, that's pegged, so you have this sort of sickness going on down in the short end here. But this is still reflecting sort of free market pricing. It is being influenced, but it's still, the free market is still mostly setting those prices. But then you see this, you go from this positive curve to where it does sort of start to flatten in the long end of the curve, the free market end. And the difference, the spread between these is not great enough. And then when we get up to today, this is very low, and it's too flat. And this is saying that there is something wrong with the market. Now, the market is going higher. Can it still go higher? Sure it can. It can go higher for quite a while. As we saw back here in '06, this started flattening and went inverted, and it kept on going. It was predicting that there was something wrong, but the markets kept on going for a year. So I just find this very interesting, all this stuff that's going on, and I love to revisit this every 6 months or so and take a look at it. I hope you got something from it and you understand the yield curve even better. So if you got anything from this video, please like it, share it, and subscribe to our channel. Thank you very much. We'll see you next time. This video was brought to you by goldsilver.com. I'm proud to say we've been one of the most trusted dealers for over a decade now. We have fast, free shipping and a price match guarantee. While our competitors serve you ads, we serve you education. And that's the difference with goldsilver.com. To learn more, click the info button. Thanks.